Thanks for joining this morning live. It's always nice when there's a little bit of company on the call. But as always, we're going to hit the record button and try to keep the background noise to a minimum because most people do watch this by a video a little bit later. All right, so we'll jump right into kind of a fundamental overview real quick. There's been nothing that's changed over the last week or 2 weeks, really. The fundamentals are bullish, and there's no way around it. Our bean carryout, our corn carryout are collapsing. A lot of people are talking about a bean carryout under 100 million, a corn carryout under $1 billion, and we need to ration those commodities because the world supply is just lower than it needs to be, and frankly the demand is higher than it needs to be because and there's a couple things driving that, right? One, it's the USDA trying to push numbers around on the balance sheet to make it look better than it is. And China is just out of food, so they're buying everything on site. And then underpinning all of that is a broader global issue, which is inflation. And countries are worried about food inflation, and so food security is a real thing. So they just keep buying it up. So there's nothing that's changed in the fundamental landscape. People start talking about, well, South America, right? They're harvesting their soybeans. Well, here's the problem: is that they have a good crop, but we've been trading the size of that crop for a long time, and they're behind on their harvest. So the pressure that we normally get is at best delayed and probably drastically muted. So we're just not getting that hedge pressure that we would normally see either in corn or beans because they keep getting further and further delayed. So now we're at a critical juncture because now we're in the month of February and our new crop contracts are now in their averaging periods. So what is going to cause this market to break? I mean, think about it. If the world is short food, and right now is the critical time to buy acres because lots of our working capital loans and lots of our budgets are built off of the February a crop insurance price, right? Which is the average price during the month of February. What are we going to do? Drop new crop prices a buck? That makes no sense in this situation whatsoever. So corn with a balance sheet under $1 billion is tighter than it was in 12 and 13. Beans with a balance sheet under 100 million is tighter than it was back then. And in fact, if we don't ration and slow beans down, we're probably technically negative, and the market's job is to make sure that doesn't happen. So we're not going to break new crop prices very much if we break them at all. So we've got this problem where new crops got to come up because it's not buying acres. I mean, the corn bean spread right now is 2.58. It's favoring beans, but 11.50 is not enough to get super excited about anything. And 4.50 corn is, I mean, guys, our crop insurance number was $4 last year. That only 50 cents is what we're going to get. We're going to rally old crop $2 and cap new crop at a 50-cent rally and call that good to buy more acres. I just don't buy that for a second because we've got too much room to go. We've got too much weather to trade. We've got too much uncertainty on the global landscape. So now, contrasting that is the fact that markets don't move in straight lines, right? So we're gonna rally, we're gonna break. We talked about this several months ago that as a rally unfolds, we're going to see daily trading ranges expand. And in fact, we've seen that happen in beans dramatically, right? In 2018, 19, and for most of 20, if you had a 20-cent range day in beans, that was a pretty significant day. Most of them were between 10 and 15 cents, right? Corn was trading 4 to 8 cents on a normal day. during that time period. We're expanding those. Most of them, and for the most part, we've doubled the daily trading ranges. So corn is now out to 12 to 15 cents. Beans are now out to 40, 50 cents. And I think we're getting ready to double those ranges again moving into the summer, where corn's going to be trading 25 to 30 cent daily ranges, and beans are going to be trading a buck. I think we're going to get wild, and here's why. Number one is the fundamental side that we're looking at, right? We're sitting with an absolute powder keg if we turn dry. Number two, the Board of Trade, the CME, is permitting the hedge funds and the large traders to increase their position size on March 15th. Today, they are limited to trading only 30,000 contracts, okay? They are getting ready to just about double those limits to 53,000 or 55,000 contracts, some huge number, right? And you think, my God, nobody could possibly trade that big of lots. Well, they do. That's why there's limits. And they've got so much dry powder because we've printed so many dollars and we've seen such inflation in the equity markets. These guys have made an unfathomable amount of money. They've got the cash to put into commodities if they think they're going to get really hot. And right now they're trading probably close to their limits. And when we double them, they're going to use the runway that we're getting. And why does the CME group want that to happen? Because it trades off commissions. It's how it makes its money. It wants the big traders to trade more often and more frequently. So with that, you're going to get bigger and bigger swings. So having said that, right? If you're a farmer, we've got to make sure that we're aware of what our risk is. So in the nearbys, I think that the nearby contracts are going to get absolutely wild. I think that new crop is just going to come up, and it's not going to be as victimized by the wild swings until later on, until they become the front. But I think for the next 90, 120 days, buckle up because it's going to get fun. Now, so let's look at the charts and let's look at what they're telling us. All right, I've got the daily chart of corn in front of us, and what this is telling us. I love and hate this chart both. I'll be totally blunt with you. On one hand, I absolutely love the strength. Right? I mean, we came off of last week. We had a nice break. We came off of last week, rallied, but we keep hammering this 550 number, and we really just can't get above it. In fact, we've closed at it once. We haven't closed above it yet. We've traded above it now several days. I would not call this a failure at all, but I would say that we're getting a little bit of pushback on prices. And so you might say, oh, well, that's got to be bearish, right? Maybe. Remember the weekly chart that we've been talking about for several weeks where there's a gigantic $1.50 gap at 550? Yeah, it's a big deal when we trade inside that gap and start closing on it on a daily and weekly basis. Gaps fill themselves. And so corn, I don't think is going to go straight to 680, but I would probably bet that 680 is coming before 380. In this market, I think that there's a much higher probability of that happening. So we want to be aware and we want to be buying breaks. If we're lucky enough on the short-term chart, all right. So I love it because everything's good from an uptrend perspective. We've done no damage to this trend whatsoever. In fact, we're probably kind of consolidating, getting ready to push it higher. The only thing I don't like is this giant divergence down here on the force index in the MACD. Remember, a divergence is when you have a higher price on the chart with a lower reading on your indicators, on your oscillators. So when those diverge, it's telling you that we're taking maybe a little bit of a pause. Well, to satisfy it, all we've got to do is kind of come down into this 520, 525 area, and it would fully satisfy it. And the hard thing about trading divergences is that you can just reverse and move on higher and blow this divergence up out of the water. So it's not set in stone, and and it's a chink in the armor, but I wouldn't call it a like a run to the sideline, oh my God, the sky is falling type of deal. Because now I'm going to back this out and give you some perspective on your weekly chart. We talked about this last week, how bullish this candle is. This is last week's trade where we had an engulfing week where we totally engulfed the prior week's break. So we had a big move up. We traded inside the prior week's range and broke it. Then the next week, we completely rejected the lower prices and ended up. Guys, that's really bullish. We went back all the way to the early 90s, and we can't find a weekly setup that's like this. And why is that significant? Well, you need a really bullish setup. I gotta drag this thing back because here's your gap. And I know this is a weekly chart, and I know that there's on the daily chart there's not a gap, but there is on this one. So you gotta kind of take it for what it is and say, man, we close up inside this level, up above this 551 level, and that gap is open all the way, 626. The gap of this week, the low of this week right here is 684. So you got a $1.30 gap that's right at the level that we're trading on. So as I zoom back in on this, there's nothing weak about this chart. Now we're not going to go straight there, and like I said, it's going to get kind of wild in the middle of it. But I see no reason to sell it. Who cares if it backs up and needs another running start to get through it? That gap's a big deal, and we're trading levels that we haven't seen in a long time. So I'm bullish corn and want to buy a break. I have no interest whatsoever in selling or pricing anything in new crop because the risk is up in this market, not down, for all the reasons that we've been talking. We will change our mind at some point, but that is not today. All right, let's look at beans. Because beans have a little bit different tenor to them, right? We rallied, but and now we've broken. So now we're in a consolidating pattern for the last week and a half, right? We've got 1, 2, 3, 4, 5, 6, 7 days here consolidating between 1337 and 1380, let's call it. All right. So what's happening? Why are we consolidating, and where might we go on nearby beans? Remember, we're bullish because we've got a ration demands because our carryout is negative. So it's really hard to see a break coming. But the bigger the move, the more extreme the breaks. So I cannot rule out a move down into this 1250 area. And that can happen really quick. How am I getting that? Well, it's real simple. It would match this move. We know that markets tend to correct in three-wave patterns, and you can count an A, a B. We could go get a C here. Most of the Elliotians don't agree with that because they think this little bar right here was our B wave. We had A, B, C, and that this is now tracing a 1 up, 2 down, and we're ready to explode up higher. So we've got a really attractive risk reward here, where if this is a 1-2 and this is a C, then we could explode up out of here. And your first target is 1484. Above that is 15. And I don't want to get you overly excited, but you're talking all the way up to potentially $18, $17.50 on a move higher. I don't think we get there all in one shot because we're going to have some massive shakeouts along the way. But that's what this setup is. So, you can buy it today, put a stop in right in here at 1332, and you've got a really, really nice 20-cent risk reward. Risk 20 cents to make dollars. That's really attractive by any way you look at it. Or you can wait and be more patient and buy a move up above here. Now, the contrary, or the alternate count, right? The alternate opinion is we break this level, we break these lows below 32, and we trade down to $1.50, down to 12.50. Well, maybe selling it is a good idea. I don't think so, because look what that does. That just moves you down into the daily cloud, and that's where you're going to find all kinds of support, is right down in here. So I'm not bearish beans at all. I do think that we could end up with a move to the downside, but the best reading right now, and the reason I'm saying this is because we don't have a divergence on this chart. We're above our cloud. We're above our fast and slow lines. Our Chiku, or our trailing indicator, is above price action, which means we're bullish and that this should generate some support moving into it. So we're looking for this market to move higher, not lower. And we start breaking these prior days highs right in here, and I think we're off to the races on beans. And we could get really crazy. The alternative count is we break lower, but until we consolidate down in here and rule out that as just an extension of a wave count, then we're staying really bullish. And remember, we have a negative carryout. We have to ration beans, and we're not doing it. And new crop is only trading at 11.50. So I'm not bearish at all. I think we're going higher still. All right, so let's look at wheat. What's our everybody's favorite step kid gonna do, right? That's kind of how the market views wheat too. And this is probably the weakest chart, but it also might be the most attractive because it's actually generating its own ABC correction that's more mature than everything else. And if it moves higher, $7 is an easy target for it. Remember, wheat is being fed in Oklahoma and Texas because it's cheaper than corn. How do you get that? Well, $6.16 is the nearby price of wheat. If you look at July corn, it is trading, where are we at? July corn. Well, let's go March. March corn is trading at 540. March wheat is trading at, let me look at it real quick. March wheat is trading at 613. So you've got an 80-cent spread, which is right here. You've got a 72-cent spread on the two. You adjust for basis, and you have wheat that's cheaper than corn. So because basis is negative in the panhandles, and it's $1 over on corn. So you've got a situation where corn is rationing itself by putting wheat into the feed rotations. That's bullish wheat, guys. We can't just feed everything and feed all our wheat and export all our corn, because the rest of the world might want to come buy our wheat. So I think wheat's got to be bought down in this area. I think corn's got to be bought on a break, and I think beans have got to be bought on a break. And from a risk management side, I think we want to be patient and look to manage that new crop as it crosses, up into that $5, $5.50 level, because I think it's got to come up $1 to really be competitive. And I don't know when that's going to happen, but I think patience is the key. So obviously, if something changes, we'll change with it, and we'll try to get some protection put on. But I think for now, we want to be patient. Clearly, as these ranges increase, the most important thing I can tell people that are trying to trade this and trade it day to day is the risk in this market is big. You're going to have huge ranges, and you should not trade more than you're comfortable losing. And you think it was hard before, it's going to get harder because the swings are going to get so big. So trade small, trade smart, and keep a broad perspective, because these things can change on a dime. I appreciate you guys calling in, and we will talk to you next week.